So today's healthcare panel is going to focus on some trends that we're seeing in healthcare, also some funding tactics, and really what we're seeing in this different equity environment. So my name is Shelly O'Donovan. I own a company called the Authentic Influence Group. We work mostly in pharma and in the healthcare space. I also teach at Wharton. And with that, I'm going to actually ask my panelists to introduce themselves. So we'll start with you, Steve.
I'm Stephen Katz. I have a management consulting firm called Stephen Katz and Associates Inc. And I've been
I'm going to say John should push back a little bit, and let Steve push in. And same thing with you, Andrea. If you can push back a little bit, and let. Actually, I'm going to ask Shelly to move off screen.
Okay.
And let switch seats with Gaurav.
Okay.
She's the voice of reason.
Thanks. Oh, it looks perfect.
Okay.
Yeah, but that one also makes it.
I'm president of Stephen Katz and Associates Inc. It's a healthcare consulting firm. I've been that for 39 years. I have prior industry experience. And my firm does diligence on healthcare transactions. Our focus is life science, healthcare, and related. I raise capital. I sit on boards. I've been on 15 or 16 public boards, 15 or 16 private boards. I participated in 5 proxy fights. I've been involved in 70 license and strategic alliance agreements over these last 39 years. And above all, 14 turnarounds where I stepped in for 6 months a year, and in one case, 19 months to straighten out a previous mess. And that's my background.
Green salutations. Again, first off, I just want to give a big hand. Where's Marty at?
Yeah.
He disappeared. I think he's coming in. Probably give Marty a great round of applause for putting all this together. He's an absolutely fantastic and valued resource for all of us. My name is John Michael Cataldi. I am I've been working in tribal indigenous economic development for well over a decade. I had the pleasure of serving as the CEO for the Seminole Tribe of Florida for all their economic development and businesses, about 47 of them. I've also served as a co-managing partner for the Native American Venture Fund, which I would like to say highly profitable ESG, social, governance type projects. And the idea is to leverage tribal dominance domicile to give the tribes an unfair competitive advantage in those portfolio companies. I'm currently an interim CEO at Clear Health Pass, which we're pioneering advancements in clinical diagnostics to be able to early detect cancer, chronic conditions, and even mental health issues and infectious diseases. And we've had a significant impact. The lab which we acquired has significant impact in actually identifying COVID within the United States when it first changed its variants. Committed to that of tribal sovereignty so far that I even went as far as going to law school. Not that I'll ever practice, and there's lots of lawyers in here. And again, you guys have your areas of expertise. I just want to speak legalese. And I had the distinction of serving this country for about 8 years and have proudly served as a business executive for national security, and will be soon consulting for legislative policy for the FDA and CMS under a tribal domicile to help guide those regulations as it would affect Indigenous America and doing business off the reservation.
And I'm Gaurav Mehta. I'm with Pinta Capital Partners. We are a private equity group focusing exclusively on healthcare services investing. We manage about 10 billion in the family office AUM. Most of that's real estate. We're the largest owner of skilled nursing in the country with over 750 skilled nursing facilities in our portfolio through Pinta's sister company called Aurora Health Network. And then on the Pinta side, we have about 30 to 35 private equity companies at various stages, from early stage through buyout. I would say half of which are about control, largely focused on the elder population that we serve in our facilities. One portfolio company that some of you may know of is Genesis Healthcare Services, the largest skilled nursing operator in the country. So we actually own them as well. We bought them out of right before bankruptcy a few years ago.
I started.
No kidding. And so, so that's a little bit about us. I've been doing healthcare investing for probably around 7 years total. Prior to that, I spent 10 years doing investment banking, mostly recently with Citibank, worked at a variety of different bulge bracket and mid-market banks. And started my career in actually strategy consulting with Deloitte Consulting. And chemical engineer by training, so everything I learned was kind of on the job. Thank you.
Hi, everyone. My name is Andrea Bartzen. I am currently working with the Middle East on a fund out of the UAE that is deploying capital primarily for women's empowerment. It's a $2 billion fund. And I'm architecting and deploying capital for that fund as it relates mostly to healthcare as the first part of that, around healing and wellness. And it will act as an incubator type of model as well. I'm also separately working with an AI company that is changing the ecosystem, could potentially change the ecosystem of the pharma market by reinventing how drug discovery and development is done, including looking at causal factors of disease and developing drugs around that kind of mentality. My background is in big pharma. I come from the industry, so I've been with the big boys pharma for about 25 years, and I did the strategy behind roughly 20 blockbuster drugs, everything from Lipitor to Keytruda, and reinvented medicine around new game-changing science.
Excellent. Well, I would like to start with just a question around the trends in healthcare that you're seeing and how that might affect investment decisions. So, Stephen, I'd like to kick it off with you, if possible.
Sure. It's very interesting. We all understand valuations have come down. We all understand there's a ton of capital on the sidelines. And I've raised capital 70 times. And I started a raise in September. And for the first time in many, many years, I'm falling flat on my face. And I'm getting very little of it done. It's extremely embarrassing, but I've been very forthright with my client. And it occurs to me that I'm not the only one that's going to have, is having, has had, and will have this problem until the great soothsayers from the last panel agree that 24 will be a better year. So, so you know, fingers crossed for a better year. So what? Pardon?
Fingers, toes, everything.
Everything crossed, hoping things will change. So what do you do when you started out at level X and you think that you've already made the necessary corrections and adjustments for what you think the market conditions are, but when you get out there, you get hit with a brick or you run into a wall and it's impossible. And you've got to try to preserve valuation because things will turn. There'll be another round in the company, and you know you got to pay attention to a lot of things. So how do you do that? So you either have to look at staying with the current valuation and offering other goodies, or just making an outright adjustment to valuation. So what I did when I started this financing is we offered a 1x pref. And if no one knows what a 1x pref is, be happy to explain it, or I'll just say it in a word. A preference is that when an investor puts up his funds, he gets a 1x extra return. So if he puts up, if the company raises capital and the proceeds of a sale down the line are $10 million, whatever the investor put up, the investor group put up, they get their money back first, and then everything gets allocated based on the other. I start out with a 1x pref and a certain amount of options, and I said, this is a great company. It's got AI, it's got checks all the boxes, management, boom, brick wall. So what do? You go back and you reposition, you offer a 2x preference. You pick up the number of warrants. Now, people can argue that the number of warrants you're putting out is dilutive to the valuation. It's a philosophical point of view. It's a statement. Typically in a private company, no one exercises a warrant until the company exits, so it's not really dilutive. You just have to, as the company management, the board, you have to recognize that at exit, those options are going to become equity 3 days before the transaction, and you're going to have that relative dilution. You can pick up the preference, or you can do a combination of those things. I think the other thing that you can do is, if you're raising 10 million and you're raising it at X valuation, you may want to back up, reevaluate how much capital you need to get from the current time to a realistic benchmark at a future time, recompute the amount of capital needed, add a bit of a cushion, do an equity raise, do another kind of raise, adjust the valuation, meet the benchmark, then raise the balance of your capital at a higher valuation, at a lower valuation, same valuation, and proceed from there and raise additional capital. The other option that you could utilize adding warrants to that on the first raise or the second raise. You can then offer a preference. You can mix and match, but you're basically working with warrants and you're working with preferences and you're working with valuation, and you've got to find a middle ground and sometimes by bifurcating the raise and making a smaller target, meeting a benchmark, you often get a chance to bump the valuation. So the aggregate raise is likely to be at a higher valuation than the initial amount, even in a bad market, with a comparable or reasonably comparable amount of proceeds. The other thing that you can do is you can structure the initial raise after you bifurcate out a smaller piece. You can structure it as bridge debt. So bridge debt gives the investor an advantage of having a debt instrument versus an equity instrument, because an equity instrument comes last. He's got a debt instrument, sometimes collateralized by IP, sometimes not, preferably not. But if necessary, you can put the IP behind the bridge debt. If it's a big enough bridge, you don't want to hock the IP of the company for a small bridge debt. And when the equity round comes up, the IP collateralization falls away. Another mechanism to utilize would be the ability to give an equity discount for the convert, so that if the target valuation is 50 million, you do the bridge debt at 42 million, you have a 10 or 15% advantage. So the way these deals get structured is there's a bridge debt amount, and once a certain amount of equity is raised, you construct the bridge debt, so the bridge converts on a mandatory basis into the equity. The equity, the bridge investor gets 120% of the equity that he initially was intended to get. He still gets his warrants, and when he converts into the equity, he's still got a preference. If there's a preference feature built into the equity, and obviously in today's times you want to do that, having the preference is kind of a makeup for the equity, because if you're giving an investor one more turn at the equity return, you could leave the valuation reasonably commensurately higher for that same amount. So, that's an option as well. Now, that may not solve the problem, depending on the company and depending on how much you raise and depending on the status of revenues, status of product development, et cetera. And we can then resort to a variety of other transaction opportunities, which one of my co-panelists is going to be discussing shortly, and that is we can go to conventional debt. We can enter into a licensing strategy, which removes the capital requirement. If you get an upfront payment on the license, you get some capital. The investing party may put up the equity to do the development activity. Or you can enter into a joint venture arrangement where you contribute technology, product, know-how. The co-venture partner contributes capital, market access, distribution. And I think you can have a variation on those themes. So you've got either a lot or a little bit of armamentaria to play to save your deal, depending on where it stands in the priority and depending on the investors that you're speaking with. So are there any questions? Comments?
There seems to be an extreme amount of bridge rounds out there right now, especially in the healthcare space.
There's a boatload of bridge rounds. Look, Marty, at the end of the
Are bridge
day,
rounds keeping people from marketing to market? That was the question. Was that a question yesterday?
I think that's an accounting issue. It's a portfolio issue for the funds. I don't know the answer.
Does
Anybody?
somebody know if bridge rounds keep people from marketing the market? Definitionally,
Repeat the question?
do bridge rounds keep you from marketing to market?
From marketing to the market.
I mean, you're talking about like a debt
So
round?
you raised a round
Yeah,
and you had a valuation of 100 million, but really your company is worth now 50 million. But you're getting a bridge round, but you're facilitating via some kind of, discount on the next issuance, right? So, but really.
So it's gonna be on the investor. It's gonna be on the investor, not the company.
Well, if the company uses that bridge round to grow itself, you can never stop raising capital. I always look at cash is king, debt is a little bit of a boat anchor, but it's a necessary evil to push it to the other side. So once you're able to take that debt and quickly utilize that debt to better position the company or the portfolio, at that point, then you could probably garner a higher valuation.
Maybe the better way to
Well,
describe
that's
it
the
is
game,
that
but
bridge
you-
round postpones marketing to market.
yeah.
Marty's
convertible
question
debt,
is,
right.
what happens to an investor who needs to be in GAAP and needs to report his
okay.
valuation to his investors, needs to report annually, may have SEC or other reporting guidelines, and there's an accounting principle
That
of
does become accounting.
marking to market. So that's a question for the portfolio, that's a question for the owner of the instrument.
Mhm.
And I guess, Marty, whether it's a debt instrument or an equity instrument, you've got to mark the instrument. to market.
you're blocking the view.
So,
I
and
say
just,
that, it seems to me that whether it's a debt instrument or an equity instrument, you've got to mark the instrument to market if you're an investor.
So I'd
and
like
just,
to.
sorry,
Okay.
and just to back up a little bit, for anyone that's invested in biotech for the past 2 years, you'll know that the market has declined drastically. There's been 93% less IPOs in the last year. Revenue has gone from 35% to 1%. So if anyone's been invested in the market, then that's the reason why we have to be creative in financing, and in business development as well, or how does this business survive? I think is one question, or, what's going on behind the scenes. So I think there was this inflection of interest in the biotech market because of COVID. And so there was a lot of capital that went into it 2 years ago. So we're kind of balancing out. I don't think it's as bad as it seems, but it's actually because there was so much inflection in that, there's some of that that's coming out. A. B, there's so many biotech companies that went into SPACs and went public too early at phase 1 or even preclinical. And they had no business really going public because they didn't have the milestones, they didn't have the data, and those companies couldn't be de-risked.
Is there any data on how those SPACs have performed?
Well, yes. So for instance, 55% of biotech companies now have less cash on, have barely 2 years of cash on hand.
55%, wow.
Yeah.
Of private.
Yeah, so I mean, the bottom line is, if they don't have enough cash to last them to phase 2 data, the likelihood is that they will not survive. So they need to be creative in how they find capital and not just the traditional sources.
So, I'm sorry, my question was about the
Yeah.
SPAC performance.
Could I just
Oh,
respond to
SPAC
that?
performance,
Was it like
yeah.
95% or below $10? Or-
So
Yeah.
Marty, I just saw a study in the Wall Street Journal about 2 months ago, and I'm on the board of a company that went public via SPAC, and
Okay.
we're one of the 5 that are successful, that we're trading over $10.
You can't see you on camera.
Pardon?
You can't see you on camera.
You can't see me on camera. Okay. So, thank you. I moved away because you were speaking.
No,
So the answer is that of all the SPACs that were done, there's only 5 that are above underwater at this point in time.
5 in the whole universe.
5 in the whole US
Healthcare
universe.
SPACs or just SPAC SPACs?
SPAC, I believe SPACs overall. And if you're following what the SEC is doing, the SEC is really gone after SPACs in a very vigorous way, in a much more aggressive way than they've gone after reverse mergers in the old years. And I think that we're going to see an end of the era of SPACs. There's been maybe 5 been done in the last 8-9 months. I think,
I've heard that before.
yeah, I think you're going to see this. I mean, I don't fund SPACs. I don't have a dog in the fight. I just, you're not going to be seeing SPACs for a good while at this point anymore. A good while, could be 2 years, 5 years.
Well, I was gonna comment that MIT Business School did a study on biotech firms, claiming that 88% of them failed.
Yeah, that's no surprise.
88% failed. Right.
I think we need to define the category of biotech, 'cause that's just a big generalization. You could say that 70% of all restaurants within the first 3 months fail. But again, that's a huge generalization.
Well, what I mean by biotech, typical pharma for medical devices or
But
even digital.
But what stage? Because again, you have the concept, you have the clinical stages, where are you at within that commercialization process? And, in the way that Native American Venture Fund and, one of the portfolio companies we'll talk about here in just a little bit, we skip a lot of that process. COVID was amazing for us. Now, first off, one of the companies that we acquired was doing $150 million. And then post-COVID, boom, big, giant cloud. However, there's so much amazing technology, patents that were created, technologies that now go uncommercialized that has already 8 times 510Ks or already went through all the regulatory approval process. Now, you don't have to do a roll-up or you don't do a creation of your technology. You can do a roll-up of existing technology and your commercialization time cycle for us, as an example, we're also CLIA high complexity lab, so we have a little bit of advantage. The usual time frame is 2 years from concept to the FDA approval process, and sometimes much longer. Ours is 90 to 120 days. So commercializing already existing technologies, bringing it together, and there's also some tribal leverage in there we'll go into here in just a little bit, but it shortens the time cycle, shortens the time in the market, and creates commercialization opportunities. So it's not necessarily the devil's in the deal, devil's in the details, not necessarily the deal. Deal could be solid. However, you've got to shorten your timeline to marketability, whether through license or a shortened commercialization cycle.
So you're doing something very, very valuable, because I think that the gentleman there is saying one thing and you're making a very valid point. You're buying into a troubled opportunity after an FDA approval has been obtained or has been started. A lot of the dollars have been sunk cost, and you're coming in with incremental dollars, no doubt at a bargain valuation.
Very much so. Usually
Putting up some extra dollars. I think what you're saying is cold turkey startup, not intermediate stage doing a B round, a C round, or a further round. He's saying that the statistics on a cold turkey startup biotech is 88%. That meets
I would agree.
that meets the common sense test.
That might be true. I covered bio for 10 years. That's all true. We were talking about phase 1 company.
Yeah,
It takes about, it takes all the way to approval, like 20% is about the right level. Right. Yeah. But that said, if you're
take that risk of the IND, which an 88% failure rate, and I talked to JP Morgan, they feel the same way. So it's not the only group that's on HIV cap, and JP Morgan feel that there's large.
I think everybody's looking at the
But
same
again-
data.
I think
Yeah, but
it's
it's-
all true. You're looking at it from a portfolio approach. When you're investing in biotech,
Yeah.
you don't put all your eggs in one basket. You got to take a portfolio approach. It's like the VC model in many
Well,
ways,
like
right?
the numbers are saying best in 10 and 1.
Yeah,
That's
And
definitely.
it depends on the sector. The devil's in the details. I think you're right, because there are some sectors within biotech that are absolutely booming. So cell and gene therapy, immuno-oncology, AI is off the charts. So there, and even look at the GP1s, people want to, those are, just, it's a market in itself. So if you look at what's trending in biotech specifically, and you follow those trends, the categories are super important.
Well, even in
And-
categories, I saw a presentation, cell regeneration, a mouse with broken back. And they claimed that this is San Diego company, they claimed to make a walking animal. However, I talked to Pfizer, they did the same test. Now, an IND phase, when you're dealing with humanized mice, it might work. When you treat it on a human, it doesn't work.
Right.
And that's the problem.
Well, that's the age-old issue of you can't correlate animal data and you can't correlate specific animal data to a human result. The animal data gets you to an IND to commence human clinicals. No one pre-IND is trying to say that what you do to a mouse or what you do to a rabbit or you do to a pig is gonna manifest itself in a human. It's an iterative process.
And I think that's grant funded. I mean, there's lots of grants out there with NIH, what have you, to be able to put that R&D in place, and we use grant funding. We're actively applying to lots of grants or the Moonshot protocol, what have you, and at the end of the day, that's for cancer. For the end of the day, that decreases our R&D risk, you know, practically almost makes it a profit center as opposed to a company burden of cost of operation. So again, we have to go back to the model and the stage of where the company's at, and not just this broad generalization. That's really where portfolio managers come into play and say, this is yes, sir.
John, do you get special treatment as a Native American tribe for grant in the grant process?
Yeah, no, that's a good question. No, actually, that's a great question.
We're interested in making money, right?
Yeah, so, you know, in essence, you still have to stick to the fundamentals. I mean, you have to have, the company has to have all the bones of good management, a good market, and all of that. What tribes offer is that, you know, we have, it has self-determination, self-governance, meaning that a tribal nation, it cannot be sued, which is really nice when you're in biotech. I say everything I'm saying is within aspects. Under the Binding Act, 30% of all federal contracts must go to a qualified Native American tribe. As the only CLIA tribally owned diagnostics lab, that's big to us because there's billions of dollars in those monies out there. For us, that would equate to about $100 million a year for the next 3.5 years, or a reset of the next current budget.
So it's a ready-made off-taker.
There's already a ready-made off-taker. And the biggest thing is, we don't have to abide by a lot of, I say we, the tribes, the tribal nations themselves. We don't abide by state law unless we abrogate that. And there's many federal laws that we do not have to necessarily comply with, but we have to be advised to. So as an example, the FDA is changing, they want to take over what is a lab developed test. Under several executive orders and several legislative enactments, they have to talk to a qualified Native American tribe in the space. We happen to be the only tribal Native American high complexity CLIA lab in the space. So are we going to help write the regulations to help safeguard not just what's happening in Native America? And everybody thinks Native America is on the reservation. Supreme Court said Native Americans wherever they have an economic interest. So if we rented this space, this would be in essence a tribal embassy. So wherever we have those economics, the tribe of the sovereignty falls, and that even goes to our FDA approval process. Within 30, 69 days, we can talk to the head of various governmental bodies to be able to get ahead of the curve and talk to them about how they're writing their contracts and their grants, et cetera, and so on, versus waiting to be the receiver of it and then answering it. So it's a much more interactive dialogue.
It's a very enviable
That's the
position.
question,
Very
why
enviable.
don't you have a fund, like a distress fund, that all you do is just go to these bankruptcy courts where fantastic companies just don't have capital, and you buy out the top 5 out of 100 and say, great, they don't have to, the courts have to give you first.
We did that in a bankruptcy just recently. They dismissed the bankruptcy and allowed us to take control of the company as a debtor in possession.
And then they wiped out the creditors, or what happened?
Well, we got, there were assets in the company that were unencumbered, which we took, and everything else would be a good steward, and we're just liquidating those assets. But the net result of that is we've been able to get a $15 million bridge out of or a $15 million.
You can take all the IP
It's a
and
license
wipe
to
out
steal.
everything else.
So
I won't say license to steal, it's a license to do what's in the best.
It's a wonderful edge.
It's not a bad edge.
Another big trend that's happening in pharma is around diversity, not just with that population, but with all populations. So you can connect diversity with precision medicine. So traditionally, trials have been 95% Caucasian men, just because they have less comorbidities. But now, because of AI and because of technology, you can actually include a very diverse patient population and still have great trial results. So there's a collaboration being done now with African Americans now that we have data because of COVID, Hispanics through MIT Co-Creation Lab, and they're designing trials. One is being developed now for Merck for prostate cancer, and most of the patient, or a large percentage of the patient population is African American males. So it makes sense to have that patient population in the trial. And then on top of that, the FDA is already starting to change guidance where they have to have diversity in the trial. So that's where
There's actually, I'm so glad you brought into that, because again, if you look at most of the population clinical studies have the typical, white guy that studies are on, and in various age groups. But medical diagnosis, misdiagnosis, 33%, preventative mortality, 50%, cardiovascular disease, 33%, cancer, 50%, health and mental disparity, 22%. Now, if you take Native American, or sorry, African American, times that by 2.3. You take Hispanic, you could potentially go to 2.8. You take Native American, times it by 7. So there is, the diversity is such in disenfranchised communities as well, times those numbers by 3% over the general population. And that's Midwest, impoverished, impoverished communities.
You almost need a separate clinical for that class of citizens.
You really do.
Yeah, so AI is allowing us to do things in the industry that have never been done before. I think that's one case. Another case is that because of AI, we can actually look at the fundamental causal factors of the disease and then develop drugs based on those causal factors in genomic sequencing. So you can identify the clusters that cause the disease and then, develop around that. And it goes outside of all industry or scientific bias. So it's an exciting.
And there is a link to the pet population as well that we saw in the pandemic. Department of Defense and others look at most pandemics being caused by zoonotic transmission. They put forth, I think, several $1 billion on that as well in some initiatives that we're going after. We were doing it pre-pandemic. We actually showed that dogs, cats, family pets, 65% of pet owners, or those in the United States pet owners, 85% come in contact directly with the animal. So that's a whole other aspect of healthcare, through the animal back to the patient population.
So these companies that are struggling, what kind of advice would you give them if they're having a hard time getting to that next round of funding? Or are they just gonna be dead in the water?
Well, they have to either reinvent themselves or either
As
be
my
forced to
accountant
be
has
innovative
tripled
by,
the bill,
expediting
I'm
the
looking for
final
a new
process or-
accountant. So do
they-
any of you have one you can recommend?
What was that?
I think it's another room.
Yeah, I would say, what I'm seeing with several kind of earlier stage companies, not necessarily biotech, but even like digital health or health tech, healthcare IT. There's a lot of extensions rounds happening. So they go to their existing investor base, they get the same valuation, sort of bridge it to the next round. And there's a company I'm invested in that I did exactly that. And so I think that's pretty common. And then, you talked a lot about, sort of different forms of financing. On the healthcare services side, I think one thing that wasn't mentioned, which is probably more unique to healthcare services, is sale leaseback of real estate. So oftentimes facility-based businesses have real estate underneath them. And interestingly enough, when you buy a SNF that happens to own its own real estate, or you buy certain facilities, oftentimes it'll trade at a multiple inclusive of the real estate. Not always, but if it's a smart seller, then probably not. But if it's kind of just, your average seller, sometimes you can get the deal with the real estate on the EBITDA multiple and then turn around and flip the real estate over to like a Welltower, Omega, or Ventas, one of these like healthcare REITs, and use that as financing to go buy the business. So it's non-dilutive. It's a great way to kind of, sort of finance it.
You were in the
In a
cross
tough market.
collateralization of that. That's how the takeover target that we had, he was cross collateralized, not only himself, but all of the business entities as well. It worked out well for us, not so well for him.
So
Another
John, the way
aspect
to
is-
get around that is before you do the financing, you gotta get the real estate out and then set up a ownership of the real estate, lease the real estate back to the entity so the principals can control the real estate asset, charge a lease to the operating entity, and they get capital out of that. And you don't save it for the investor, you let the principals use it.
Well,
Yeah.
I think that is an asset of the company, but my market is I want the IP to get quick commercialization. My valuation is based upon, we have the Clear Health Pass, or one of the primary portfolio companies to take these individual tests, like Exact Science, makes people play with their own poop to check for colon cancer and then send a swig of their poop in by mail to get diagnosed. Problem is the 70% misdiagnosis rate. Our test, initial trials was, we're looking north of 90% with already existing FDA technology with saliva, not poop. So, and they had, out of the gates, they were over $1 billion. Today, I think they got over in second quarter, 2.8 billion. And they're right around $11 to $13 million publicly traded valuation, so.
You're talking about Cologuard.
Cologuard, yeah, that's Exact Sciences.
So, I know the company well. It's a Mayo. It initially got started.
You're not even a
So-
picture.
Another,
I just want to finish my
aspect is
thought, if
through-
it's
oh,
okay.
sorry.
Thank you. Cologuard initially had to get, Exact Sciences, had to get an approval that made its false positives or its false negatives at an acceptable level. There's a guideline for this. So they initially had an appropriate approval level. It may be that it's deteriorated, that's the FDA's fault. So, if it's not accurate anymore, but in order to be approved, then that would have been probably a phase 3 510K. They probably had to meet a guideline that the FDA has for accuracy.
Under a wellness diagnostic, so they do have some CPT codes on a state basis.
So they're not a phase 3?
I would have to go back, they have various levels of tests, but the one that's pronounced out there is.
The big one. I think the big one's a phase 3 510K.
All right.
I'm guessing. You could be right.
I
I'm
could be
guessing.
wrong.
Another aspect is how you bring in capital and not through traditional sources. So it could be through licensing agreements or partnerships with other companies of the same size to build revenue. Fred did that recently. He accelerated his revenue by having a partnership with another company. So creative ways like that to bring in capital through other sources. Also, the Middle East is funding innovation faster because they have to get out of oil and gas. So they have a higher risk appetite for risk. So that valley of death, you have to look outside of, I think, just US markets and look at it from a global perspective in terms of distribution and capital.
It's about 3 minutes.
What about market service risk? I mean, the age population is big, and I think here's the expert on the age population, 65 plus. What's the, what do you see as the market outlook on the age population in that
Let
next?
me give you a stat so that you can.
Please.
In the next 7 years, 65 plus is gonna double in population from 30 million to 60.
Holy,
Yeah.
wow.
Yeah. Oh, yeah. I mean,
7 years.
yeah.
My CFO was watching
Market's
United
not going
Humanity that
away.
time. Wow.
Huge market
Aging
opportunity.
population.
And
A lot of people.
all of the worst diseases in that population, because that's in the life count.
Yeah.
So nursing homes,
Oh, yes,
everything about that whole population, is interesting, very exciting.
it really is.
Yeah, no, I mean, so the fundamentals are strong. But we're talking about a business that represents 18% of GDP that's only going to grow. We have a funding problem with Medicare and Medicaid, state budgets, federal budget to fund all this massive growth that's going to occur. And so, I can spend half an hour talking about the trends around this, but I think what you're seeing is a push to get elders in the home, out of SNFs, out of LTACs, out of hospitals.
Right.
And technology reimbursement is gradually aligning around that to take care of that population. And we're well aware of that. We're actively looking for home health, home care businesses to acquire platforms. We're actively, RPM is going to be, is becoming huge, or it's already big, but it's going to become bigger. Right now there's some issue. People are scared about whether there's going to be reimbursement or not for RPM, which is remote patient monitoring. Excuse me, I'm using acronyms here. The reality is CMS can be all over that. So I think, people shouldn't be concerned about that, in my opinion. But that's where the future is headed. We don't have enough money in the government coffers to fund all this. So, we're going to have to get AI. We talked a little bit about AI. There's going to be a lot of technologies that are going to be really kind of be developed over the next 5-10 years to support a lower cost of care of that patient population.
The waste is
Now
so
they're
huge.
trying,
Especially preventative.
Now they're
health.
trying
We need
to-
it.
Oh, it's insane,
There's,
especially on the hospital side.
a lot of innovation happening in each of these categories, whether you talk genomics, diagnostics, AI, and a number of other neurological categories that are all converging. So that acceleration of innovation is going to be quite disruptive. It's actually going to redefine how we categorize the industry, because we talk about health and wellness, we talk about biotech and life sciences and AI as if they're separate categories. They're all one. So your DNA is code, and when you analyze your genomics and you decipher and predict what you're going to get, it's health and wellness. So we talk about markets, we're gonna have to redefine how we even set up our financial paradigm. So the whole structure of everything is gonna be changed, which is quite exciting, I think, and a lot of opportunity, and healthcare is gonna look fundamentally different in even the next 3 to 5 years than it does right now. And I think it's exciting.
No question about that.
That's exciting,
I
actually.
mean,
Great place.
just look at the M&A for like Optum and
Great
United
job, guys.
Healthcare.
Thanks so much.